Joining me to discuss that and a lot more is Sean Darby, the Jefferies Chief Global Equity Strategist, joining us now. Sean, you look a little bit shocked by that call from Goldman Sachs. Well, is it very bold?
Well, I think it's generally acknowledged that equities are in a better position than bonds, but we've had an enormous rally over the last 6 months, and positioning now in equities has become quite aggressive. So I suspect that you need to sort of put this into the time frame that we would have to look for some form of correction between 5 to 9% in equity markets, given the risk appetite that's already been placed into shares.
Correction in the next 3 months?
I would say probably after first quarter. I think people have desperately squeezed into equities to meet performance, but after that I think we're going to find that unwinding.
So it's a case of the horse has bolted and Goldman Sachs comes out and says it's time to say a long goodbye to bonds, i.e. farewell, and embrace the long goodbye, as in buy into versus sell, for stocks over the next few years.
Well, I think the trajectory, as we've seen over the last month, is for yields to move up, but it won't be in the policymakers' interest for those yields to continue to rise. I think we will see further QE or monetary intervention or financial repression to keep yields down. So I think you've got quite a bit of time to switch out of fixed income into equities. It's not in the policymakers' interest to keep let yields move up.
It's often the case that the contrarian investor often makes more money.
Well, I think contrarian...
If you follow the crowd, you're going to switch out of bonds into stocks, but you may have missed the boat.
I think in the short run, yes, you certainly have. And I would also just point out that we're still not over the European crisis. You only have to look at Portuguese spreads and where Spain has been trading to think that there's going to be an awful lot of more bad news coming out of Europe, particularly on potential debt restructuring for some of those economies.
Now, we did sort of tease you into the idea of buy sushi, sell kimchi, just for the viewer, and that includes me. Kimchi is this cabbage.
It's a spicy pickled cabbage that's served in Korea as a starter, and it's a very favourite appetizer for people in Korea.
Sushi sounds a better taste.
It does. It's quite a neutral taste.
May explain your take on buy Japan, sell Korea.
Yeah, more anodyne. I think the perhaps investors have under-recognised the fact that it's been Korea that's benefited from a very weak won versus Japan, and I think in the interim you can do a nice spread trade by buying Japan and selling Korea, potentially as the yen weakens further on not only policy moves but also the fact that some of the data points have actually been a little bit better in Japan over the last month.
In the last month, I must say, Sean, that a lot of guests have been saying buy Japan, the reconstruction, the redevelopment, the money going into it, the weaker yen this year. It's a very good opportunity to invest.
Well, it's been a career killer over the last 10 years, and I think there's an enormous amount of scepticism about any type of Japan recovery. I think there's three things just to add. One is the market's been very cheap, it's been very under-owned, and out of the developed markets this year, it's got potentially 60% earnings growth over the years. So I think, again, from a bottom-up basis, people are finding a lot more stocks to buy in Japan than elsewhere.
China is all about the Lewis turning point. Arthur
Lewis won a Nobel Prize looking at when wage rates change in an economy, and potentially an emerging market economy, and those inflection points tend to mean a very big change in the overall destiny of the economy. And somewhere around about 2005, 2006, China's Lewis turning point occurred, and that is the profitability for China from its low, cheap labour has started to disappear, and therefore potential GDP gains are going to be perhaps a lot more lower than people have going to potentially expect.
When your clients call you up and say, Sean, please tell me where the best value is in Asia right now, asset class and also country.
I think it does come to swing towards Japan. I think Japanese equities do quite well this year. It's potentially looking at the inflation protection bonds in Japan. They're all signaling some restoration of inflation going forward. After 5 years of deflation, I think it's turned for Japanese equities to do well.
Christine Lagarde was saying on Tuesday night that a far bigger worry for her is the oil price, now at $170 a barrel, more so than euro. Now, with the oil price clearly as an inflation, that obviously is a big headwind for Japan, for China. right across the world. Is it, Jefferies, your biggest concern?
It is actually. Ironically, academic literature shows it's actually 1 year afterwards the peak in oil prices that has the maximum amount of impact on the economy. So it doesn't look that it's affecting us right now, but 12 months out, these economies start to slow by anywhere between 0.3 0.5% GDP, and subsequently another year afterwards as well. So yes, it's going to be a big drag on growth going into 2013, 2014.
What's the biggest, final question, what's the biggest relief that you've seen looking at data?
I think it's the fact that US data has actually continued to surprise on the upside. I think that's really what's pushed people into owning stocks, as you mentioned.
Smiling there.
Yeah, I think that's been the key. Potentially the bottoming in the housing market in the US and the better employment data. That's really been the last quarter's sort of confirmation of some sort of self-sustaining recovery.
And existing home sales falling by 0.9% overnight, more or less in line.
Yes, I think if you look over the last quarter, the data on housing has actually been a lot better than people have expected.
John Darby, always a pleasure to have you on the show.
Thank you very
Thanks
much.
for coming in, Chief Global Strategist at Jefferies